The stock market is crashing hard. What the duck is happening? What the duck happened to US stocks? Because over the past few weeks, US stocks, especially the Nasdaq and tech stocks, have been dumped to the tune of $1 trillion. That was already pretty intense. But just last week, another $3 trillion got dumped. That really stings. If you're an investor right now, grab your spoon. Just hang in there. Thank you so much to everyone, whether you're showering, driving, working out, doing yoga, or whatever else you're up to, who's watching Zai Money Monster. Right now, our subscriber count is almost at 100,000. I really want to hit that 100,000 mark. If you haven't hit the button yet, please hit subscribe for me. Or if anyone wants to support the Zai Money Monster channel, you can do so right here. Just scan this QR code. This will help support the Zai Money Monster channel so we can keep making new high-quality content. Because this income will go to the team members, giving them more motivation to create quality videos. And honestly, it also encourages me to keep creating fun content. But if you don't feel like scanning the QR code, just liking, sharing, subscribing, or leaving a comment to show your support already makes me really happy. Thank you. So let's get started. Let's start with this graph, capital outflow. This graph shows the capital outflow from the Nasdaq stock market, 1, 2, 3, 4 consecutive weeks. You know what this is like? It's just like back in 2022 in the second and third quarters when there was a period where capital flowed out of the Nasdaq for several weeks in a row. And that caused the stock market to, not just the Nasdaq, but also the S&P, dropped in a correction down to just 3,500 points. That's pretty similar to the current state of the market, which is making investors start to feel, well, anxious about what's happening. You can easily see this from the Fear and Greed Index, which measures investors' fear and confidence. Right now, the score is at 27, which puts us in the fear zone. It's a fear territory, and there are only 2 points left. Then we'll enter the zone called extreme fear, or as I like to jokingly call it in Thai, the screaming fear zone. So what exactly are investors afraid of in this kind of fear zone? They're probably afraid of a recession. Most recently, Goldman Sachs came out with a forecast that next year, the US economy is likely to face an increased risk of recession. They've raised their previous forecast from 15% to 25%. It doesn't seem like a huge jump, honestly, because even though the market isn't doing well right now, the United States is still the United States. Everything can turn around completely at any moment. There are actually ways to prevent a recession from happening. In this video, I'll explain how that's possible. But first, let's take a look at what's happening with the US economic system. Because the state of the US economy that we're about to see from now on, it might not be a total collapse all at once, but I'd call it a slow motion shot. It's gonna fall apart slowly, almost gracefully, like it's happening in slow-mo. Collapse. So today, I'm gonna stir fry a plate of recession for you, pad krapow style. I just wanna give you a clear comparison. Let's say, for example, if minced pork is the main ingredient in pad krapow, just like people having no money and no jobs is the main ingredient in a recession. Let's start by looking at this chart. As soon as you see it, you'll immediately understand how not having money or a job goes hand in hand with a recession. This line up here is the payroll line, or the employment numbers. You'll notice that when it slides down just a little bit, it looks like a tiny dip because the graph is so big. It drops. Whoa, is it really that dramatic? Like heavy earrings? This top line is the payroll index, representing employment. Notice that every time there's a slight dip, the line below, representing the US economy, drops sharply right after. And those really deep drops, those are recessions. And this pattern happens every time. As soon as employment drops, a recession follows right after. See, during this period, employment was high. It dipped down around the year 2000, and that's when the 2000 recession happened, the dot-com bubble. Then employment dropped again around 2007, which led to the hamburger crisis recession, right? After that, employment dipped a bit again around 2019, and that was the COVID crisis. Now, this same pattern is happening again because employment numbers, or payroll in the United States, are getting worse. They're on a downward trend. Take a look at this chart. You can see that US payrolls right now, judging from the graph, are definitely trending downward. Currently, the number of new jobs is only at 114,000 positions. And down here is the employment rate. You can see that as hiring dropped to just over 100,000 positions, the employment rate shot up. It's now at 4.3%. And if you want to look at the exact number of unemployed people, you can check by looking at the number of unemployed people who have applied for government assistance. You'll see that the number of people applying for unemployment benefits from the government is as high as 2.1 million. This is the highest figure in the past 32 months. This issue of unemployment, this leads to problems with spending, basically problems with consumption, because it's really easy to see. When people don't have jobs, no jobs mean no money. If you don't have money, what are you going to spend, right? And when most people don't have money, this is the core of the economy's value. Unemployment is rising, cash is getting tighter. That's no sign of a healthy economy. Even elementary school kids can tell you that if people don't have jobs, they don't have money. That means the economy isn't doing well. The second ingredient in this recession dish is that factories aren't getting any new orders. I'll compare it to basil leaves. Just toss the basil leaves right in. That makes the recession even more fragrant. Let's take a look at the index. The ISM index, which is an index that shows whether factories in the United States are getting more orders or fewer orders. Even though right now the United States has declared a trade war with China, they've already imposed barriers on China, raised tariffs on Chinese goods, and encouraged Americans to buy more products made in the US. So we should be seeing more manufacturing in the US, right? But that's not what's happening. The ISM graph clearly shows that manufacturing in the US isn't actually increasing. And it's even below the 50 line. Being below 50 means the sector's not healthy. Do you know why? Because when you suddenly say, hey, don't buy goods from China for domestic manufacturing or consumption, the fact is products from China are way cheaper than American ones. And then you turn around and tell people to support domestic products and buy American, you have to consider the costs and everything else involved in making things in the US. There's no way it can be cheaper than buying from China. Plus, putting up trade barriers with China, it actually ends up hurting big American companies themselves, hurting them to the point where they're strapped for cash. And it could get so bad for these companies that there's no telling where it'll end up. Let me give you an example. Intel. Intel is a chip manufacturing company. Their profits plummeted by 85% from their peak, which was around 2021. Back then, they used to make nearly 80 billion US dollars in revenue. And that hefty chunk of revenue, most of it came from sales to China. But starting from 2022, President Biden banned the sale of high-tech chips to China, and their revenue took a massive hit. Up until now, it's like their revenue has been hammered down. It's dropped to just 50 billion US dollars. Money disappeared, and problems showed up right away. Now they no longer have any money for R&D. Of course, when it comes to giant companies like this, if their revenue drops, the first thing they usually do is lay off employees. Intel is preparing to lay off 15,000 employees. This is just part of it. This is partly why the US unemployment rate is rising. This company is just one example. Many more are losing their jobs. As joblessness grows, people have no money to spend. So how can they afford expensive things? This is basically the origin of a recession, but as for the recession stir-fry we're talking about in this video, this is as far as we'll cook it for now because honestly, I don't really know how to cook, and with just these ingredients for this recession dish, it's still not a full-blown recession yet. I'm just saying that it's starting. I don't really know how to cook, but I'm using it as a comparison to cooking. But at this point, what we can say is that we can make a prediction about how stock prices in the stock market will behave. Because at the end of the day, stock prices ultimately depend on a company's performance. And a company's performance depends on how many people use its services, or how many people buy its products. How many people will use the services or buy the products? It largely is determined by how much money the majority of individuals in that economy have. How much money they have depends on how much income people are able to generate for themselves during that period. And that depends on whether people have a lot of jobs or not. So to sum it up in a simple formula, stock prices depend on earnings, and earnings are basically people's ability to generate income at that moment. They have to be based on the real health of the economy. Technical analysis alone can't fool you. So when a lot of people are unemployed, you just can't have a strong economy. Now, let's talk about when the US economy isn't doing well. So right now, everyone around the world needs to tighten their belts, really tighten them. Because any kind of economic collapse that happens in the United States, it never just ends in the US. That's because the US is a huge consumer country. So if the number one customer country in the world faces an economic downturn, the whole world will be affected. Is there hope? Many now predict the Fed will cut interest rates. If so, the economy should improve, right? JP Morgan and Citigroup forecast the Fed will cut rates by about 25 basis points. 25 basis points. But Goldman Sachs is predicting that there will be 2 consecutive cuts, each by 25 basis points, making it a total of 50 points. So will the economy actually improve if interest rates are cut like this? Let me explain first how cutting interest rates works as a mechanism and how it affects the economy. Normally, when the Fed lowers interest rates, right, capital will flow more into risk assets. The risk assets we're talking about include stocks and cryptocurrencies, because when interest rates are lowered, it means U.S. government bonds will also have to lower their yields a bit. So people will move their money from safe havens like bonds into stocks more. Now, when companies and businesses see interest rates go down, they'll be able to borrow money more easily because the cost of borrowing goes down because interest rates are lower. So now it's expected that if interest rates are cut, first, more money will flow into the stock market. And companies and businesses can borrow more, so the economy should improve. But we have to look again at the real intention behind the Fed's interest rate cut this time. What exactly is the reason for the cut? Are they cutting interest rates because inflation numbers are okay now? Does that mean prices of goods and products aren't expensive anymore? People can afford things, they have money to spend, and the economy's doing well, so that's why they're cutting rates? Is that really why they're cutting rates? Because from what we've discussed, none of that is actually true. The Fed isn't cutting rates for those reasons. They're not cutting interest rates because inflation hit the target. Rates are low because the economy is recovered. The U.S. public debt of $35 trillion is the highest in history, not just for the U.S., but globally. The government's budget is also running a deficit. The deficit is negative 6.6%. Even though they're borrowing that much money, the budget is still that far in the red. But the financial resources they borrowed never actually makes its way to the people. They can't even use it to generate new employment opportunities or help people sustain their own livelihoods. The more money they continue to borrow, this is the scale of inflation we're talking about. So if they lower the interest rates, it just increases the chance that inflation will rise even more. When inflation goes up, prices for everything get higher. And that happens at a time when people are out of work and can't earn an income. People's quality of life will just get worse. When people's quality of life gets worse, when they still can't even put food on the table for their families, that's what you call earnings that just aren't successful. Earnings will collapse too, because if people don't have money or even jobs, where are they going to get the money to support anything? So do you really think the stocks of companies listed on the US stock market will go up? Comment below. But in the middle part, I mentioned earlier in the clip that there is actually a chance that all of this might not lead to a recession because there are choices. There are options that could prevent a recession from happening. It's not even that hard to do, and the United States has done it before. Just print money and inject it directly into the system. Just like during the COVID crisis when the economy didn't collapse. If the US decides to print money and pump trillions of dollars into the system again, there's still a possibility that a recession might not happen this year or next year. But the problem isn't going anywhere. Everything that's happening now is like stumps that have surfaced underwater. If we let the water level drop, even if we can't see the stumps today, the stumps aren't going anywhere. They're just gonna pile up and explode the next time around. And don't forget, these stumps have already been piling up since COVID. If they surface now, it's gonna hit even harder because we've carried over the stumps from COVID into this round of recession. But if we still refuse to let a recession happen and keep pumping money into the system, then we'll just be combining the stumps from 2 crises together. And when it blows up next time, it could be even more intense than before. Or maybe, just maybe, a hero on a white horse will come and somehow clean up all these stumps. Who knows, maybe. So that's why investors are worried about the news that there might be an interest rate cut, because this time, it's happening when the economy's health isn't good. To paint a picture, think of the economy like a patient, and then they go and start slashing down interest rates, which is like suddenly disconnecting the breathing tube. So this recent reduction in interest rates is like pulling the ventilator tube out of a patient who hasn't fully recovered yet.